Have you ever heard the myth that to make money trading you have to win all the time? It sounds logical, right? More wins should equal more money. But this is one of the biggest myths in trading. The truth is much simpler. It comes down to math, not magic. You can lose more trades than you win and still come out ahead. This isn't a trick. It's a strategy. It all boils down to one question before you click buy or sell. Is the potential reward truly worth the risk? Let's break this down into simple, everyday terms. In trading, risk is the amount of money you are prepared to lose on a single trade if you are wrong. You define this by setting a stop-loss order. A stop-loss is an automatic instruction you give your broker to close your trade at a specific price to prevent further losses. It's your safety net. On the other side, reward is the amount of profit you aim to make if you are right. You define this by setting a take-profit order, which automatically closes your trade when it hits your target price. The ratio is simply the reward divided by the risk. The formula is straightforward: potential reward divided by potential risk. We usually write this as a ratio, like 1-to-1, 1-to-2, 1-to-3. Let's look at some clear examples with numbers. Imagine you are trading and decide to risk $100 on a trade. If you set your take-profit target at a level that would earn you $100, your risk-to-reward ratio is 1-to-1. You are risking $1 to make $1. Now, what if you risk that same $100 but set your profit target at a level that would make you $200? Your ratio is now 1-to-2. You are risking $1 for the chance to make 2. Let's imagine two traders, Alex and Ben. On the surface, Alex looks like the superstar trader. He boasts a very high win rate, winning a whopping 80% of his trades. He loves the feeling of being right and closes his trades for small, quick profits as soon as they turn green. Ben, on the other hand, seems to struggle more. He only wins 40% of his trades, meaning he is wrong more often than he is right. If you were to invest your money with one of them based on win rate alone, you would almost certainly choose Alex. But you would be making a huge mistake, and here's why. Alex's strategy is to aim for a $20 profit on every trade. However, he hates taking a loss, so he lets his losing trades run, hoping they will turn around. When he finally accepts defeat, his average loss is $100. Over 10 trades, Alex wins 8 times for a total profit of $160. 8 times $20. But his 2 losses cost him $200. 2 times $100. After 10 trades, despite being right 80% of the time, Alex has a net loss of $40. Once you are in a winning trade, you can make a smart move to protect your capital. This is where moving your stop loss to break even comes in. Let's say you entered a trade with a 1-to-2 risk-to-reward ratio. You risked $50 to make $100. The price starts moving in your favor. A simple and effective rule is this. Once the trade has moved halfway to your profit target, in this case, once you are up by $50, you can move your original stop-loss order up to your entry price. This is now a risk-free trade. If the market reverses, you're closed at your entry price, no loss. If it continues and hits your target, you bank the full profit. This disciplined approach is what separates amateurs from professionals.